Still, for Clinton, shoring up the ranks in her run for the White House is not enough to silence her critics. I spoke with House Speaker John Boehner, asking him what he thinks of the former First Lady running for president.
What's she going to do for America? That's the real question.
All of that coming up. But first, weakness out of Europe this morning weighing on the futures. Worries over Greece sending investors to the safety of German government debt. The 10-year bond yield falling to a record low, below 0.05%. Joining me right now to weigh in on this is the man in charge of the largest asset manager in the world, BlackRock, Chairman and CEO Larry Fink, with $4.8 trillion under management. Larry, great to see you. Good morning to you.
Hi, Maria.
We want to get into what's happening in terms of these yields. But first, let me get your take on the latest out of Greece. It did not feel like there's real confidence in terms of the markets that Greece will be able to pay the next debt payment, which is May 1st, and then another one coming May 12th. What's your expectation in terms of the Eurozone and Greece?
Well, I think the market has it wrong. I think it's actually good for the Eurozone that Greece leaves. Greece is not a systemic problem. In 2012, Greece was a systemic problem, but over the last 2.5 years, the private sector has sold all their Greek debt. There's less than $4 billion of market value of Greek debt held in private hands. The Greek debt is now held by the ECB, the IMF. It's all been socialized into these institutions. There's a lot of Greek debt, obviously, sitting in Greece. I have greater fear if Greece is given easier terms and that the Troika, the Europe grouping, including the IMF, they capitulate and give easier, lax terms. To me, that's far more systemic, because then you have parties like in Spain called the Podemos party, a very left-wing party, and they're calling for relaxation of their debt payments, and then Portugal will call for relaxation of debt payments. And then the whole financial structure, how Europe was created, is going to start crumbling. Having Greece leave the Eurozone actually will create a rally in the euro, because Greece is like the weakest link in the whole thing. So I believe the best thing that would happen over the weekend, that Greece does capitulate, they make the payment. But in no way do I want to see the Europeans capitulate on the terms to Greece. Now, if they could find a way that's cosmetic, that relaxes it a little bit, okay, I could accept it. But the last thing I would like to see is a real relaxation of the terms that were agreed upon by the state of Greece. When a state or country agrees to terms, it's not a political party's ability to change the terms. And it was a country that agreed that they will accept those terms to the rest of Europe. A new political party comes in and says, we don't want to honor that. I find that very difficult, and it'll create tremendous political risk. So, as I said, I think the market has it so wrong today.
So you would like to say, actually, you would not mind to see Greece leave the euro. It's probably better, so that you don't have this wondering if they're going to change their standards.
Well, I think everybody privately would agree that Greece could never pay back those payments. They just don't have an economy that'll pay back that debt.
You just saw it on Christine Lagarde's face.
Yes.
I mean,
everybody knows that. And so, can you keep this going? If Greece capitulates from their demands, and if Greece needs just a little short-term fixes to give them the time to make these payments, okay, I got to certainly accept that. And I hope that's the outcome, because you don't want. It would be very bad for the Greek citizens if they were thrown out of the euro. They would fall into a depression. You don't want to see that for anybody, for any country. But if they're going to continue to create the demands that they want a change in the contract that the state agreed upon prior, that would represent tremendous systemic risk. And I think the market today, I'm kind of surprised I would be buying today on the dip, because to me this is not a problem. So
you would buy Europe right here. You think Europe continues to go higher? Europe markets have been unbelievable.
Maria, I think Europe, aside from Greece, aside from living in a bad neighborhood of North Africa and Russia, the surprise in the first part of 2015 is a stronger Europe. The ECB finished the bank stress test October last year. It took them 6 years to stabilize their banking system, unlike the U.S. when we did our stress test in 2009. So they have a stronger banking system. They are benefiting by weaker petroleum prices. And most importantly, they have one of the most aggressive central banks that, through their actions of now buying bonds, you now have a devaluation of the euro from 139, where it was 7 months ago, to 108 as we sit here. And that is putting significant pressure now on the United States and our exporters.
Yeah, and that's what you're seeing in terms of ETFs, people going into Europe, huge. Let me ask you about BlackRock for a second, because you reported earnings this week. Unbelievable inflows that you've had this year and for the past several years, but this year in particular. You're talking about what, $250 billion over the last year?
Yes.
Congratulations.
Thank you.
Where is this money coming from?
It's all over the world. We're benefiting by having a better business model. We're in 35 countries. We're the only firm that has active passives, including ETFs and alternatives in the world. And so we're seeing a mixture of flows in our mutual fund business. We had $14 billion of growth, $7 billion of flows in the U.S., $7 billion in Europe. Much of it was European equities. We saw $35 billion in flows in our ETFs through our iShares division. And we had our fastest growth institutionally that we had since 2007. We had $21 billion of flows institutionally. So you add it up, we had $70 billion of long-term flows in the first quarter, and then obviously we had the 250 over the 12 months.
That is so great, Larry. So active versus passive has been a topic we've been discussing, and there is an increasing sort of voice out there that believes that it's the year for active. I don't know why, because everybody has been going into ETFs thinking that, you know, you just want to get exposure to the averages or the indexes. What's your stance on active versus passive? What should investors be doing?
We believe there's a role for both types of strategies. Keep in mind, when people invest in private equity or hedge funds, that's an active strategy. So people are not running away from active strategy. They may be moving from traditional active equity strategies to maybe untraditional strategies of some sort. Actually, in the first quarter, active strategies did quite well as an industry in terms of performance. Now, however, the last 3 or 4 years, the majority of active equity managers underperformed after fees, and that's why we've seen such a run into ETFs. I think they're, depending on how one wants to construct their portfolio, there's room for both. I can make a strong case why active in some strategies will make sense. Our European equities team for 5 years outperformed the index handsomely. They're one of the top decile investment teams in the world. But I look at active managers in equities, Maria, almost like sports figures. When you think about baseball teams and hitters, you have only 20 or 50 hitters who could hit over 300, and the rest of them are pretty mediocre. Mm-hmm. That's the same thing in active management. Not all of them are going to be able to produce the returns to offset the fees. This is why passive strategies, ETFs, are going to continue to have great flows. You know,
I want to talk about the risks for a minute in this market, because you have some worries and cries over liquidity in fixed income. Yes. Do you worry about that? And I also want to talk about nominal negative interest rates.
Sure.
Let me bring